Hi, everyone, and welcome back to AI InterConnect Podcast. I'm your host, Laurent. On this show, I sit down with founders, operators, and investors to understand how they actually build, scale, and survive in complex markets. AI InterConnect is a platform for real conversation with leaders who are shaping industries from the inside without hype and without sell pitches. Today, I'm joined by David Karabinos, chairman of the board of PointClear Solutions, an entrepreneur, and PointClear Solution help organizations improve and extend the shop to the software industry that already rely on, especially in complex and regulated industries. David, you will say much more, obviously. And thank you for being here. Very, very happy to have you on the show.
Well, great. Thank you, Lawrence. I'm excited to be here.
Wonderful. Finally, we made it. And let's start with your background so listeners understand the path you led you here. You have one of those career that spans corporate leadership, entrepreneurship, board role, and capital markets. That range is rare. And David, how did your early years running large technology business units led you to become a founder, capital raiser, and long-term business builder?
Right. Well, let me spend just a few seconds just kind of giving context, and then I'll respond to your question. First 20 years of my career were in corporate America, in enterprise, in different industries, in technology, and running technology business units and organizations. It was a great experience, had a lot of responsibility toward the end of that period, but I did want to be an entrepreneur. It was in my blood, if you will. And so it's not that I ran away from the enterprise world. It's that I ran to the startup world. And that was it was right around 30 years ago. And there's a lot that goes into that. And I wouldn't mind sharing with you at some point during the conversation the difference between the corporate world and the startup world and trying to move people from one to the other because they're two very different cultures, operating models, risk profiles to individuals that work within each of those domains. And it's really not always that easy to move from one to the other.
Yes, for sure, for sure. And thank you for this introduction. That what was the moment you knew you had to leave corporate America and build your own companies?
I think it was the fact that in corporate America, my responsibilities included doing things that I necessarily didn't enjoy that much. Administrative things, working around HR problems with the people that I led, and that sort of thing. Now, the startup world, you have all of those kinds of things, but you get to focus on what's important, which is the success of the company that you're building, which would include generating revenue, generating profit, marketing, sales, growth, returning capital to your investors, their returns. So those kinds of things are enjoyable to me, fun to me, in building teams. And some of those things transcend from the corporate world to the startup world, but many don't. And there's additional risk and attractiveness to being in the startup world, which just fit really well with me. And I felt like I wanted to give it a try. I was in my early phase when I made the leap of faith, which is a little bit late typically, but I thought I better try now before it gets even later. So I did, and I've learned a lot and had a great time doing it.
For sure, very successful. You raised over $400 million across your ventures. What did you underestimate the first time you went out to raise capital?
Oh, wow. So when I finally decided to leave the corporate world and start my first startup, it was 1998. During the dot-com bubble. It was bubbling up to the top. It didn't bust until March of 2000. But you know, I left the world and I took a year off to really understand what it would take to build a successful startup, including raising capital. And I really didn't know much about it at all. So I wanted to learn as much as I can before I started working really hard at it. And the the process of raising the capital, I thought was just so unique and different and difficult and challenging. People may or may not recall, depending on their age, what it was like back then. And it was a little bit what some people called irrational exuberance. It seemed like money was falling out of the sky when it really wasn't. It was falling out of the sky to maybe 20% of the people seeking those funds. And I had to learn how to position a company to make it attractive to investors. And I had no experience at doing that. So that was quite the experience at that time.
Yeah, I remember that time. Yeah, that was scary. That was a big spike up, and and the way down was even
Yes.
scarier. Yeah. Um, okay, then you have described yourself as a business guy, a capital guy, a business builder. That clarity is powerful. When when you explain your current role, whether at PointClear Solution or in your advisory and board work, how do you describe what you actually do and who you help?
How I advise companies. Is that what you're asking? How I advise companies? Right.
Yeah, I know it's maybe different from one to another, but who are you helping and how do you advise it?
Right. So in 2006, I had successfully built a company with two partners, and we became number one in the world at what we did, which was advising the global 2000 corporations in outsourcing their operations, their IT, HR, procurement, finance, and that sort of thing. And we sold the company to KPMG. And I took some time off and decided the next phase of my life was going to be giving back. And so I became board chair for a technology incubator for 8 years. And that was my way of giving back. I ended up investing in some of those companies as an angel. I became a limited partner in several venture funds at the time. And I started an advisory firm, a consulting firm, a small boutique that helped young companies not only with raising capital, but with strategy to be successful. So I got invited to be on the boards of numerous companies, both private and nonprofits, over that period of time from 2006 to about 2012 or 13. And that became a passion for me. I really enjoyed it. But at one point, I decided, you know what, I want to operate one more time in my career. I had already done three startups at that point, and I decided I wanted to operate one more time as a CEO. So I took over PointClear, which was one of the companies that was seeded in 2004-5 timeframe, and healthcare technology, digital company, and ran it for 10 years. And I retired for the second time in 2019, right before COVID hit, and not knowing that COVID was going to hit. I feel young, so I decided I wanted to do advisory work at that point. So over the last 6 years now, I've been advising early stage companies, pre-seed to seed stage, all the way up to mid-market companies, 200 to 300 million in revenue, helping them in four areas. One would be raising capital. Two would be M&A on both the buy and sell side. Three would be growth strategy, and four would be product strategy. And most of these are tech companies or tech-enabled services companies. And over that period of time, I've had over 85 clients. I would say about 2/3 have been in healthcare related to the healthcare industry, and the remainder really all over the map, multiple industries, technology, and so forth. And I would say about 50% have been companies that I've helped with both strategy work and raising capital. 25% has been pure capital, and 25% has been pure strategy. It's been a joy. I get to work with really interesting people. I get to work with uh, young people for the most part, certainly younger than me, and I really enjoy it. And we've had pretty good success over that period of time. Now, you asked a question earlier, and I'm not sure that I answered really adequately in terms of raising capital. It's a interesting challenge. When COVID hit, of headwinds occurred in the private capital markets. Prior to that, I would say the period of 2012 to 2019, 20, when COVID hit, was a similar period in terms of an exuberant market for capital, like it was preceding the dot-com crash in 2000. It was very similar to that. And then all of a sudden these headwinds hit, and the companies that I started advising to help raise capital was, simultaneous to these headwinds hitting. So we had to figure out inventive ways to get these companies funded. And not all companies get funded. It just doesn't happen for various reasons. But we were successful with especially the good companies and good teams. But it was an experience over that period of time.
Yeah. Yeah, I love it. Yeah, another hard time. COVID was a tough time. We haven't mentioned 2008, but there's many of. But okay, yeah, you have had a front row seat to the shift from what you called an irrationally exuberant market. We had many of them, to what you now see as dysfunctional. And that perspective is grounded in experience, obviously. Right now, what feels like the hardest part for funders trying to build and raise in the current capital environment?
The funders, you mean the investors or the companies looking?
No, the company you're advising, your funders.
Oh, the companies that I'm advising to secure capital. So in a market, and this may be obvious to everybody, but in an exuberant, or let's call it a very dynamic, liquid, productive capital market, valuations are really a good for people seeking capital. In other words, dilution is lower. Deal structures are in favor of the people seeking capital. And then when you shift into a headwind market, there's a lot of friction that all of a sudden occurs, and valuations go down, deal structures flip to be in favor of the investors, whether they're institutional or retail angels and angel networks. So there's that massive shift. But there's also something that occurs in every private capital market over the last 40 years, I think, for venture capital. And some of these dynamics repeat themselves over and over again, which is really not healthy because that means you're not learning, but that's just my opinion. And those are that the venture capital firms, which are funded by LPs, general partners and LPs, they could be retail, they could be institutional, but for the most part, securing that money is a function of, frankly, how well the public capital markets are doing. So you mentioned 2008. That was a meltdown of epic proportions. We all know why, because of the derivative market just, was a mess. Everything became illiquid. And all those investors in the public market were also investors in the private market for the most part. Friction occurred. Everything froze up. And LPs went, wait a minute, I can't risk more capital calls putting into my funds. And so those funds became friction, valuations went down, deal structures went down. And then the companies that were seeking 1, 5, 10, 20 million in capital were frozen out. So 80, 90% of investors go to the sideline, and even great companies with great teams were failing. And then you have another thing that occurs where it's a consolidation market. M&A occurs. Startups are selling pennies on the dollar. That seems to repeat itself over and over again, unfortunately. The other dynamic that occurs is with venture capital is this is oversimplification, but there's two types of categories of investors. One would be the top tier, highly disciplined venture funds with a very clear investment thesis, a sound investment thesis with boundaries and parameters where they won't go outside that thesis and make dumb investments or off plan investments. Those companies, those funds tend to do well, but they have a lot of money to deploy because they are successful and they've raised a lot of money for these funds, and they need big home runs. They need the entire portfolio, not the entire, but the majority of the portfolio to win. And that would be winning from, minimum 3 to 5x return on invested capital all the way up to 20 or 30x. They need a lot. They need a good fair number of really successful wins. And so those companies are typically involved with they're investing in the hottest thing going. So, it could be blockchain back in the day. It could be digital health back in the day. You've seen the spikes, AI, anything AI on it today is a halo effect on it, even though everybody pretty much understands that we're going through a hype cycle, with AI, like all of these previous technologies and investable plays. And so when that occurs, when you look at the venture capital market today, roughly 80%, if not more, of all funds in the venture capital market is going to something AI related. And it can't be fake AI related. There's a lot of that out there, but real AI related. 80% of those funds are going to 4 or 5 players. So that tells you that the market is crazily concentrated right now. And so at the tops, 4 or 5 companies are getting the vast majority of the capital, just make it the top 10. They're getting 95% of the capital. And go back 10 years, you had startups that had great ideas and great teams. They were executing, but it wasn't going to be a breakout thing. So you didn't have the big venture capital players putting money into them. You had the down market, and the down market investors were investing, and this is still occurring, by the way, in these smaller, quote, companies that could only return maybe 3 to 4 at most 5x on the investors' capital over 5 to 7 years. That has created a market for smaller funds. I call them micro funds, anywhere from 10 to 50 million, and venture capital funds. But they're not disciplined. They don't stay disciplined. I would argue they maybe start out disciplined, but they don't stay that way. And they're just chasing shiny objects. And as an LP, that's not what I want. If I'm an investor in a fund, I don't want my fund chasing shiny objects just to survive and return capital to me. So that is a dysfunction in the market today. And it's been that way in the past. And that kind of goes back to my comment about things tend to repeat themselves. And I'm seeing a lot of that happen today as well.
That's very interesting. I love it. Thank you for these insights. And it makes a lot of sense. Yeah. Then many people focus on headlines, and you tend to focus on structural shifts. From your vantage points across fintech, healthcare tech, and private capital, what shift matters most right now, but it's still underappreciated?
Take AI as an example to answer your question. And I like to use metaphors and analogies. I think they're very helpful in explaining complicated things. So I use baseball as a metaphor here. There's 9 innings to a baseball game. And I think AI, the AI, even though AI that was really kind of coined over 50 years ago, maybe 60, 70 years ago, and there's variations of it, but really, it's really come on strong as, the general public can see it. Enterprise can actually see tools that they can then deploy into their footprint. But we're still in the first 3 innings of AI, in my view. That means there's 2/3 more to go until we have a fully mature market. And I don't know if we'll ever have a fully mature AI market. I think we're going to call it something else at some point in the future, super intelligence, whatever the right word is, but or how you want to frame it. But we're still in the first third. So in the first third, what do you do? In the first inning, you're doing the design and building out the infrastructure to scale something. AI in this case. Go back 5, 7 years ago, machine learning was all the rage and, data analytics. And that was kind of early infrastructure and use case development to what we're now using for AI, or we're calling AI. But AI, the next step, any two, is to take these AI tools, use them as single point solutions or integrate them into larger software solutions, and take out cost. And, that is well on its way. That that second inning is well on its way. We're really now into the third inning where we're seeing where AI is being used for not directly related to cost savings. So I was reading something the other day, for example, about physicians not adopting certain AI tools, even though it would create a better patient experience and better patient outcomes. But they were banning adoption of it because the workflow wasn't there, the infrastructure wasn't there, and the hospital CFOs they're not being successful being sold a return on the AI investment. So they're not buying it. And but so we're not getting to the next step, if you will, of the value of AI yet. This is just a bump in the road. This isn't this isn't a headwind that will persist, in my view, because the value of AI clearly will be there over time. But we're still in the third inning. The fourth, fifth, and sixth innings, because everything accelerates in business and in life, almost on a quadratic curve. I think we're going to see the same thing with AI. I think the fourth, fifth, and sixth innings are going to occur in the next 2 years, maybe 3 years. And then when we get into those later innings, we will have gotten to a point of adoption that everybody will look back at the first 3 innings and go, boy, that took a lot longer than it needed to.
Yeah, that's true. Yeah, I like this analogy. This your analysis. It makes a lot of sense. Healthcare, and fintech are both regulated,
Yeah.
high-stake environments, and there is no room for sloppy execution. When you think about companies in regulated sectors like healthcare and banking, what is the hardest operational challenge leaders tend to underestimate?
Well, I think it's the thing that hits you that you didn't expect it was going to hit you. So, as an example, in 2007, I'd had a liquidity event uh, previously, a year previous to that, and I had some money to put to work. And I had been in banking for 10 years in technology. So they put me through banking school. My company did. So I understood the industry pretty well. Investing in community banks was really popular at that time. You could start a bank up de novo, capitalize it, get it going, and then sell it in 5 to 10 years and make good money. Because the banking industry is an error. It's a consolidating market, and banks get so big, and these executives in the banks, they spin out and they start small banks, and then they sell those banks back to the bank that they came from. And that cycle was going on when I decided to join 6 other partners, 7 of us. We formed a board. We put in about 20 million of our own money, and then we started a community bank. And then 2008 hit. You brought it up, and the capital markets froze up. The regulatory environment, because there were shenanigans going on, right, in the financial industry, the regulators weren't doing their job. And so Congress came in and passed the Dodd-Frank Act, and boy, did everything change. We got hit. I was chairman of the board. I got hit with something that I wasn't expecting at all. That I wasn't expecting that to happen. And as a result, though, our compliance costs with regulations went up 1,000% in 1 year. And as a community bank, you can't afford that. You can't make money with that dynamic. So that became more than a headwind. That became an existential threat. And we managed through it for a couple of years, but we ended up having to sell the bank for a return that was far less than what we were hoping for. But it happens.
Yeah, I mean, yeah, tough time you went through.
I learned a lot from that, though.
You survive. You are not actively building a new startup today, but
Well,
okay.
I'm on a board of a couple of companies, and I will mention one if you don't mind. I get to live the startup experience, but I'm on the board and I'm not an operator, which is it's like being a grandparent. I mean, it's like you get to play with the baby, but you don't have to take the baby home every night. And so this it's a medical device company, and what I love about this experience, and I've been with the company now for 5 years plus, that we're in 24 countries now. Sell a device that controls very difficult hemorrhagic bleeding that you can't stop on the body otherwise. A regular tourniquet won't stop it. It's internal. So this device does that, and it's the only device that can do that today. And we've got a tremendous patent portfolio. We've got competitive differentiation, and we're starting to scale the company. And what's really cool about this is I get messages literally every day of lives being saved in military situations in Ukraine. It was used in Gaza. It's being used in the Middle East. It's being used really all over Europe now, and the U.S. military has been using it for about 7 to 8 years in special operations. And the device was actually invented conceptually as a result of the founder, who's an ER doc, was in the military in Afghanistan and in Iraq, and our guys were getting blown up by IEDs and bleeding out. And he said, there's got to be a better way. And he came up with the design for this device and built it and got it approved with the FDA. And now we're scaling it into the EMS civilian market fairly rapidly right now. So I get to enjoy the startup experience by kind of being a grandparent.
Oh no, that's beautiful. I love that. So then, okay, then yeah, you're on the board of different companies and looking ahead, then maybe um 12 to 18 months. What does success realistically look like for those companies that you're currently involved with?
Well, I think it depends on the company because it's not the same answer
Yeah,
for any of them.
yeah,
But in general terms, surviving through this very difficult private capital market, it's highly illiquid right now. I don't care what you read out there. It is very tough to raise capital right now. Anecdotally, when I've talked to 3 investment bankers last week about we're going to do an additional round with our medical device company, and I'm just trying to find out, okay, what's your opinion about the mood of capital deployment? And all 3 of them said it's actually starting to get better now. So we're starting to see things loosen up, some of that friction kind of releasing, if you will, which is hopeful. But my advice to my clients and to the companies that I'm aboard on, watch your cash as if it's your last penny. Spend very wisely. Don't worry about hypergrowth. Just grow and just be profitable as soon as you can. Make it to the other side, and then you'll be able to take capital at a non-punitive valuation and dilution scenario.
yeah. No, definitely. Yeah, yeah. Never overspend. Be humble. Your
But that
career.
hey, that overspending is still happening today. Remember, I talked about the AI companies. I mean, the way they're spending money is they're like drunken sailors. I don't understand it. I don't understand what I mean. I do understand it intellectually. They have massive balance sheets with all this money on it, and it's just tempting. It's just tempting to spend money that if you didn't have it on your balance sheet, you wouldn't spend it. But they have it, and they're investors that put that money on their balance sheet are expecting you to deploy it. And that's a little bit of a trap in my view. And I think that is going on for the people that are getting funded at these crazy valuations, but it's a small number of people.
That's true. Your career spans 5 decades. That gives you pattern recognition that most funders simply do not have yet. Based on everything you have seen, what should operators building today start doing or stop doing if they want to build durable companies?
So when I was board chair of BizTech, the incubator I was involved with in working with those companies, and I had also for a long period of time been on these panels where entrepreneurs are giving pitches. It's like a pitch competition. So I was one of the judges. And through those two activities for a few years, I really picked up patterns of if this entrepreneur was going to be successful or a failure. And I could read them very quickly. And I won't bore you with all those details, but just one example is if an entrepreneur, and usually it's always a first time entrepreneur, when you ask them, you know, what does the competition look like for what you do? And they say, well, we're the only one, right? And I said it just a minute ago with compression arms, but I can prove it. When they say we're the only one out there, there's never been anything like this, that tells me they haven't done their homework. Because there is always, if there's a big problem that you think you have a solution for solving, you got to believe other people are also recognizing that problem and trying to solve it too. And someone's actually been doing it before you started doing it. Just because you learned of the problem and you think you have a solution doesn't mean that's the start of the Big Bang. It started before you came along. So you really need to understand that before you risk your time, your career, other people's capital. And so if someone is stubborn about that, and stubbornness is the killer here. If you're stubborn about that, I'll pass.
Very right. If you were starting today again, uh, what will you do differently in your first 2 years?
Okay. Great question. So my first startup, it was a healthcare technology play, raised several million and finally did raise, this is my first startup, raised several million in capital. And we're building a portfolio of customers generating revenue. But I was the founder and the team that I hired were people that I picked, but I picked them because they were available. I didn't pick them because they were the best. That's what happens. That's kind of normal, by the way. And eventually, and I didn't have a board or a board of advisors. So I didn't really have anybody to talk to. And I was doing it for the first time, even though with all that 20 years of experience in corporate America, I couldn't even use hardly any of that except, you know, my basic skills of operations and people and selling and that sort of thing, but nothing uniquely valuable regarding a startup. And ultimately, the dot-com crash in March of 2000 got us as well. Private capital markets and the public markets froze up and there was no more capital. So, and we didn't have enough on the balance sheet to survive for it was 3 years before that friction lifted. So a lot of companies went out of business. And so we sold the assets of the company and I moved on. I spent about a year decompressing from that experience. And I recommend this for anybody that goes through that experience. What would I have done differently? What did I learn from it? And one of the things that I vowed to myself was in future startups, don't be the only person pulling the sled because everybody will hop on the sled and your 100-pound sled becomes a 1,000-pound sled and you can't get anywhere with that. And so my next startup, which was wildly successful, wasn't just because I was the smartest guy in the room. It's because I had two co-founders and together we built a great company. And just a quick little side note on that is we sat down. We were both very experienced. All three of us, were very experienced and roughly the same age. Well, no, I was a little bit older, but that really doesn't matter. We got together and we had a strategy and we had a vision. We'd worked together in another company for, about a year or 2, so we knew each other, and we got together and we said, "Okay, we have to figure out a way to stick together because there's gonna be headwinds and tailwinds and crosswinds, and we need to be aligned all throughout that. How do we do that?" And we decided it's having the end goal in perfect alignment. So we said, grab a piece of paper. We all got a piece of paper and a pen, and we wrote down what we wanted to get out of this experience financially, a number. So we all wrote our numbers down. And I don't know, I'm not a probability guy, but this was crazy. We all wrote the same number. I mean, it was the same number. And that kept us glued together because I mean, this was a rocket ship going off. I mean, we were we did 27 million in the first year, 27 million in revenue, and we were throwing off cash. We were throwing off profit. It was wildly successful. We were setting up shop in Europe, Canada, a little bit of footprint in Latin America. So there was a lot going on, and we were working 20-hour days, and we were making every decision. It felt like we were making the perfect decision. And this went on for a period of time. But I knew we were playing with fire because you probability wise, you can't make perfect decisions all the time. You're going to make a wrong decision and then things are going to get bumpy and, people are going to debate and argue. And that happened. And this alignment with the goal in mind helped us weather those little mini storms, if you will. And I would advise, and I do advise my clients, if you're the only person in this company pulling a sled, you need at least one, if not two people that you pull a sled with. You're going to de-risk and you're going to have a higher chance of being successful.
Yeah, I love your story. Beautiful. And great success with this great advice. Yeah, a lot of investors, venture capital says that they invest only if there's two founders and one of them are a tech guy. It used to be that way, and it's less now because with AI we can vibe code everything. That's another story. But I love your insights and your all your great experiences. Thank you so much for joining, David. That was great.
Now, I've enjoyed it very much. Thank you for the time and the experience of sharing my stories with you. I appreciate it.
It was a great conversation, strong insights into your story, your journey, your industry, and the work you are doing at PointClear Solution and across the private capital ecosystem. Thank you so much. And we have many things to tell each other, I'm sure. Thank you. And that's it for today's episode of AI InterConnect. And if you enjoy it, share it with someone who's building the future, or better yet, someone who should be. And until next time, stay curious, stay creative, and keep building. Thank you. Thank you, David. See you soon. Okay.